I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. The banks have endured a turbulent few years as a result of increasing regulatory constraints, slowing credit growth, and the fallout from the Royal Commission. 2019 was no different, with the banks generating a total return of 9.5% for the calendar year, less than half that of the broader market return of 23.8%. Of the major banks, CBA was the standout performer, delivering a total return of 16.9%. But this was still well below the return of the broader market. The worst performer was Westpac, with its share price hit hard towards the end of the year as a result of its weak full-year result, a large capital raising, and the release of a statement of claims against it by AUSTRAC. Looking to 2020, the outlook is improved marginally relative to 2019, but remains challenging. Mortgage demand has increased over the last 6 months, with application volumes recovering on the back of the coalition win in the May election, followed by 3 rate cuts by the Reserve Bank. Given the lag between application and settlement of mortgages, this has not shown up in the mortgage book growth just yet. While loan book growth should improve marginally in the coming year, the major banks are likely to experience continued low growth due to increasing competition pressure from the second-tier and non-bank lenders. This is as a result of the Reserve Bank's official rate nearing a zero rate. This reduces the funding cost advantage enjoyed by the major banks, resulting from their disproportionate share of low-cost transaction deposit accounts. Falling official rates are not able to be passed on to transaction deposit accounts as they already receive zero or negligible interest. Smaller lenders that rely more on wholesale funding are benefiting more significantly from falling benchmark interest rates, narrowing the gap in their funding costs relative to the major banks. This allows these smaller lenders to price mortgages and other loan products more competitively. While loan book growth might accelerate slightly during 2020, downward pressure on net interest margins will continue, mitigating the impact of net interest revenue growth. The increase in loan application activity should improve, but fee growth is likely to remain constrained given political and social pressures on fee pricing. Credit quality has continued to deteriorate slowly, with delinquencies and bad debts rising in 2019 from their cyclical lows. While lower borrowing rates should ease pressure on borrowers to some degree, economic conditions remain soft and labour demand is weakening. Therefore, bad debt charges are likely to be flat at best in 2020, or more likely to present another headwind to earnings growth. This puts a lot of pressure on operating cost reductions to deliver overall earnings growth for the banks. With compliance and regulatory spend likely to remain elevated in the medium term, this is likely to prove challenging. This all adds up to negligible or negative underlying earnings growth for the banks in 2020. Consequently, investor returns are likely to be around the level of the dividend yield unless the market is willing to pay more for the same level of earnings for some reason. The yield itself will also remain under pressure, given flat to negative underlying earnings growth, combined with the need for NAB and Westpac to continue to accumulate more core capital to meet APRA's new minimum capital hurdles. If loan book growth starts to accelerate, it will put further pressure on capital ratios, increasing the risk to dividend payments. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.